While investing can be a highly rewarding exercise, it's not without its fair share of risks. In fact, there are three things one can do with risk, and we've covered a lot of it in my previous videos. So very quickly, we can reduce risk by diversifying investments, asset allocations, stop loss, options, etc. We can seek a higher return for every unit of risk by identifying deeply undervalued companies, rebalancing, using metrics like the Sharpe ratio and others. And thirdly, we can avoid risk, which shall be the subject of today's inquiry, as Kunal and I explore 8 investing red flags that can help detect the first signs of trouble, making our investments a lot more secure and us a more informed, vigilant, and successful investor. Let's begin. Financial reporting is not only a key part of a company's functioning, but it's also a regulatory requirement. In fact, SEBI, the Securities and Exchange Board of India, is within its right to impose a fine of up to 5,000 rupees a day for violations such as a delay in the furnishing of the board and shareholder meetings or the non-submission of quarterly and annual financial results, etc. Now, when a company consistently delays the release of its financial reports, I look at it as a red flag, and not just me, even generally it leads to a loss of investor confidence resulting in a stock price decline. A recent example of this is Balaji Amines, which delayed the release of its 2023 June quarter results following the en masse resignation of 5 independent directors in May of this year, citing personal reasons. The company submitted this information to the stock exchange on the 14th of August, and as expected, investors looked at it as a potential red flag, and the company's share price fell by 6.5% over the next 2 trading days. Another example, and I'm sure you've heard of this one, is Byju's, whose audited financial results were delayed by 17 months or so, and although this is not a listed company, Byju's did face the music with investors now valuing it at $5.1 billion, which is a good 77% drop from where it was in the year 2022. My point is, any delay by the company in their shareholder or regulatory compliances should be looked at with suspicion, and it's better to be cautious than sorry. Section 197 of the Companies Act specifies the total remuneration payable to the directors and managers of the company, and the law says this cannot exceed 11% of the net profits. So 11% is like an outer limit, and one would expect any CEO or director to stay within reasonable limits and to not try and skim the cream out of the Section 197. But as we saw in FY21 with Sun TV Networks, the 2 executive directors, Kalanithi Maran and Kaveri Kalanithi, drew a compensation of 87.5 crores each, which was 57% of the entire company's wage bill, making it a clear case of excessive compensation. In fact, there have been instances of promoters taking home a remuneration that is even higher than the statutory limit, and they had to pay back some of it just to stay within the right side of the law. National Peroxide, which is a part of the Wadia Group, is one such company, and in FY 2015, the managing director was paid a compensation of 2.59 crores, whereas the ceiling as per the statutory limit was 93 lakhs. The same thing happened in the next financial year, with the company paying the MD 2.29 crores, while what was allowed was 1.66 crores. What is even more perplexing is that in the financial year 2015 annual report, there were entries reversing the excess compensation of previous years, so the accountants knew what was happening, and per my research, this practice seems to have gone until FY 2020. Net-net, this is a clear case of the management prioritizing its own interest over that of the company and its shareholders, which is most definitely a red flag, and investors should approach such companies with an extra dose of caution. There's an old joke that auditors in India often outlast marriages. It's kind of true, and even I have auditor friends who've been attached to a company for 15-20 years now. So for an auditor to resign in a short span or midway through a financial year is seen as a strong red flag by investors, and it almost always precipitates a stock price decline. For example, in May of 2018, the firm of Deloitte, Haskins and Sells quit being the auditors for Manpasand Beverages Limited just a few days before the declaration of annual results, which brought about a 55% decline in the company's share price. In fact, Manpasand Beverages turned out to be a serial offender on this front, with Deloitte's replacement, the firm of Mehra Goel and Company, quitting in July of 2019, which was then followed by the audit firm of Batley Boy and Purohit submitting their resignation in October of the same year. Now, auditors choose to resign for a number of reasons, and some reasons might be more important than others, but generally, if this is due to the non-cooperation by the management, fraud or misconduct, lack of auditor independence, or if there are unresolved disagreements about accounting treatments, financial reporting, critical audit matters, etc., then investors should definitely take note and avoid going near that company. Actually, midterm auditor resignations are somewhat of a trend now in India, which makes it all the more important that we pay close attention to the auditor's report and do a bit of forensic accounting ourselves, as I highlighted in a previous video. Okay, now in most companies, at least the mid, small and micro caps, a majority of shares is held by promoters of the company, and therefore keeping a track of what they are doing with it becomes all the more important. Now, like any asset, even shares have a value to it, and it's not uncommon to see a promoter taking a bank loan by keeping one's shares as the collateral, and these are then tagged as pledged shares. Now, the lender, the bank, would always have a margin of safety to these contracts. Let's say that's 50%. However, if for some reason the stock price starts falling sharply, then the value of this collateral starts to shrink, which is what happened earlier this year with the Adani Group when it faced a margin call of more than $500 million due to the sudden fall in share price in the aftermath of the Hindenburg report. Now, the intensity of a pledge matters, and if this is like 5-6%, then it's not a botheration. But if this ratio were to increase, like in the case of Max Financial Services, when it went from 63% to 87% over a single quarter, it brings in some warning signs with investors, and potentially the stock price declines, as it did in this case, by about 30%. Of course, the reverse is also true, and if some news comes in that the promoters have reduced their pledged percentage of shares, then the market responds positively and the share price goes up. The most recent example I can think of is Suzlon Energy Limited, wherein its promoters released their pledge on 97.1 crore shares, which were held with SBI Cap Trustee Company Limited, and this prompted a 15% jump in share price over the coming week. The point is, consistency and stability are two traits every investor looks for, and therefore frequent share pledges by promoters tantamounts to yet another red flag for us in our investing checklist. Alright, this is a good one and a surprising addition to our list, because who wouldn't want a high dividend payout? Everyone, right? But if the payout is too generous, then one should definitely question why this is the case. I mean, is this high dividend going to be sustainable in the long run? Is the company in financial distress, and is a dividend being used by the management to attract and retain investors? Is this generosity a proxy to saying that the company lacks growth opportunities? Are earnings being manipulated, or is there something else going on? The case of Vedanta Limited is an interesting one, and for a company that did 14,000 crores in profits in FY23, it sure was a surprise when Vedanta declared dividends to the tune of 37,730 crores, which definitely warrants further investigation. Now, the question is, why would a company do that? And the answer lies in its parent company, Vedanta Resources Limited, which has to pay back some 16,000 crores of debt in this financial year. And the dividend it receives from Vedanta Limited is one way of being able to service those loans. So essentially, Vedanta Limited and its non-promoter shareholders, the minority shareholders, are just caught in the crosshairs, which is one big lesson for us on why we should be looking at an abnormally high dividend payout with a microscopic view of things. Actually, just today morning, there was a news item that the Indian government has asked PSUs to pay a higher dividend, and I'm sure by now we all know where this is coming from and where this is going. In fact, the newsletter I'm planning to start this month will be looking at similar case studies, which will include forensics, turnarounds, some companies that look interesting in the small caps and micro cap space, news, relevant news, and a lot more. The material might be a bit more detailed than my videos, but I'll certainly write it in a way that more people can understand it, and hopefully you will learn and make good use of that information. If you haven't subscribed to it yet, then please do so. The link is there in the video's description. And I'll appreciate if you can get a few of your friends who share your quest of knowledge to to also subscribe to it. So corporate governance refers to the system of rules, practices, and processes by which a company is directed and controlled, which means its primary purpose is to ensure that the company operates in a transparent, accountable, ethical manner and in the best interest of all stakeholders, particularly the shareholders. Which further means if there are any gaps there like insider trading, accounting irregularities, unreported related party transactions, etc., or even allegations, then this can severely impact the company's stock performance. Take Brightcom as an example, and this is a stock that surged by 2,500% in 2021 alone, only to fall by 75% over the next year after the market regulator raised concerns that some of the company's disclosures and financial transactions have been detrimental to investors. Another example is Lux Industries, which hit the 20% lower circuit after its executive director was banned for insider trading, and the share price has struggled since then. And then there is Aurobindo Pharma, which was once a Nifty 50 company, but has been picking one red flag after another in terms of corporate governance issues and allegations. For instance, in November of last year, one of their whole-time directors, Mr. P. Sarath Chandra Reddy, was arrested in connection with the Delhi excise scam, which crashed the company's stock price by a good 11%. Previously, in June of 2022, SEBI had issued a warning letter to the company for disclosing very limited and restricted information about a US FDA audit in one of its API plants. In August of 2021, the company announced its decision to acquire a 51% stake in Cronus Pharma Specialties India Private Limited for a cash consideration of 420 crores. There were concerns over this deal on account of alleged related party transaction, too high a valuation, and an increased capital outlay which did enough to ensure that the stock price tumbled by 18% over the next 5 trading sessions. And although this might not be related, its then managing director, Mr. N. Govindarajan, stepped down from the company within 6 weeks of the cancellation of that Cronus deal. So these are just some of the recent hiccups with Aurobindo Pharma, but if you look into the past, the company's promoters have been fined for floating insider trading norms, and the promoters' political links have brought them under the CBI scanner. My point is, every business has its quantitative and qualitative side, and if there are doubts over corporate governance, the very trust that an investor places on the management, then I, for one, will always err on the side of caution and avoid such scenarios. While occasional fundraising is a normal part of a company's financial strategy, frequent or excessive infusion of capital can signal underlying issues that investors should be cautious of. For all you know, this can mean the company is struggling financially or has a cash flow problem. Every time a company raises capital, the stakes of existing shareholders gets diluted, thereby eroding the value of shares and the stock price. Also, frequent borrowing can lead to a significant increase in the debt levels, even affecting its ability to service that debt. And then there is market perception, wherein frequently raising capital is equated to a lack of strategic direction, potential mismanagement of funds, and of course, additional scrutiny by regulators. I want to talk about the curious case of Manpasand Beverages, and this post from 2.2 Capital is a wonderful read. While the authors talk about multiple things, with respect to fundraising, it does come as a surprise that in September of 2016, the company raised a sum of 500 crores through a QIP, a qualified institutional placement, which came just 14 months after Manpasand Beverages had raised 400 crores through the IPO process. This was surprising because companies rarely need to raise additional capital so soon after an IPO, and as per SEBI data, Manpasand had the smallest time gap between its IPO and QIP. Now, the usual story for fundraising is to finance growth, and while Manpasand was touting the same script, one should also note that per the FY 2016 annual report, the company had a little over 92 crores in cash reserves, it had no long-term debt, and at an operating profit of 56 crores and let's say an interest coverage of 4, the company could have easily borrowed and serviced a debt of around 150 crores. My point is, there was no need to go for equity financing when there were cheaper options available, but that short time gap between the IPO and the QIP has to be our trigger point and therefore the red flag in this scenario. So fundraising is not bad and it's essential in many high growth industries, but as investors, we have to examine the circumstances and also carefully analyze the reasons for the raise before making investment decisions. Alright, so this is like investing 101, and a sudden and substantial increase in a company's debt in its long-term borrowing is a certain red flag and requires more investigation on the investor's part. A good example is Kingfisher Airline that started commercial operations in 2005, was never able to turn a profit, and from a manageable debt of 934 crores in March of 2008, this airline adopted an aggressive expansion strategy ending up with 7,000 crores of debt in 2009 and 13,700 plus crores in 2012. A similar thing happened with DLF that carried a debt of 25,000 crores as on December of 2011, which was a lot lower at less than 4,000 crores in March of 2006. To put that 25,000 number into perspective, the company's consolidated revenue, remember revenue not profits, were around 9,000 crores at that time, which effectively means the company was paying 25%, a quarter of its revenue as interest charges in 2011. Likewise, there are many examples like Suzlon, Moser, Pantaloon, Punch Lloyd and others who took in too much debt in their books at too high a velocity, and these house of cards all came tumbling down. The point is, debt can be good or bad, but one universal rule for every investor to check for is if the company has enough cash now and in the future to repay that debt. Alright, so these were 8 red flags, and I'm sure there are a few more. But as a point of comparison, I want to draw the difference between this video and the one I did on forensic accounting, where we could use some parts of a standard screener to receive signals that something is not right. For instance, no screener is going to tell us that the auditor of a company has resigned, and that too because he or she feels there is some hanky-panky stuff going on. However, an auditor change is material information, and I think the only way one can acquire and process this is by reading corporate announcements, news items, and also earnings transcripts. Yes, this is a lot of work, at least the analyzing part, but receiving this information is a lot easier with platforms like Screener.in, StockX.in, Money Control, etc., offering this service free of cost. So try these out, get into the habit, build a few more of these red flags, and if you can avoid investing in such scenarios or companies, then I think that's half the battle won. Once again, thank you for your time. Do like this video, share it with others, and I'll see you 3 days from now. Until then.